say I've been looking forward to this panel. I'm understating it because it's the one that really matters. If you're deploying capital into young companies, if you're making investments, right, you really want to understand perhaps what your peers are doing in the industry. So they've assembled a wonderful panel here who actually are going to help us try and address the question, is investing in crypto companies different from investing in normal companies? But also they're going to give a much broader landscape on that investing in the industry. Titled The Ultimate Roller Coaster. Please welcome to the stage Ken Seiff, Jane Lippencott, Mabel Jiang and Victor Fischer to the stage. Thank you. You are the only panel that got a whoop today. We've got a lot to live up to. So thank you very much for joining us. So we've got some terrific investors. These are people that put their own and other people's capital at risk while figuring out how to create capital gain and develop great businesses. Can I ask you first to introduce yourselves and just for 1 minute and tell us about your fund and what you're doing. Starting at this end, please. Ken.
Ken Seiff, fund is called Blockchain Ventures out of New York, and we invest in the companies that we think are going to have the most and largest and biggest outcomes. So we take a lot of risk and we do very early stage investing.
A little bit, can you just say how the fund was formed? It was with Gavin, wasn't it?
I had two partners when I initially formed the fund, Caroline Cassie from a law firm in New York, and Gavin Wood, who's former CTO and co-founder of Ethereum and now running Polkadot and Parity.
I think you called it the holy shit sector, didn't you?
Well, we do invest in
Bitcoins.
Thanks a lot.
See what kind of a panel this is going to be.
It's just getting started.
Already.
Don't hold back, by the way. Just let them have it.
Right from the start.
We like each other.
Okay, I'm going to roll my sleeves up. See where this is going.
Jane, bring us back to some sort of normality, please.
Okay. So my name is Jane Lippencott, and I focus on crypto investing at Winklevoss Capital. Winklevoss Capital itself, I'm sure some of you heard Tyler and Cameron speak the other day, but we're a traditional family office, so we only a small part of what we do is actually in crypto. But we invest mainly at early stage, so pre-seed to Series A, and then we also invest in funds as well. I joined in July to focus on crypto, and we also hold Bitcoin.
Hodlers, we love it. Yeah. Mabel, welcome. Tell us about yourself.
Thank you. Mabel Jiang, Multicoin Capital Principal. So we are a thesis-driven fund. We have a venture fund, we have a hedge fund, which is long-short strategy. Interesting facts that although our headquarters is in Austin, United States, we have New York office, we have Los Angeles office, and myself sits in Beijing. So it's a very, I would say, decentralized fund by itself. And then we look at opportunities that of course, like bridging from the east to the west, and also I think a few important theses that we have are Web3, open finance, and stateless money. So that's about it.
Thank you. Victor, please introduce yourself.
Yeah, so thank you. My name is Victor Fischer. I'm from Rockaway Capital. We are a 500 million fund from Czech Republic. We are very traditional guys. We have a real estate fund, we have private equity fund, we have a VC fund, and we have a blockchain fund into which we put 4% of our asset under management, so we are a bit crazy. I don't recommend it. And I started my career as a consultant at McKinsey in a corporate finance practice, serving pharma companies in M&A, so I felt like at home, lived in Zurich and took SBB every day to Basel.
Wonderful. Actually, I would actually say that Victor's also contributed to the content. Do you want to just quickly mention the article that you've kindly published?
Yeah, so over Christmas, we wrote an article called Use Cases of Blockchain, which you can find on the Medium or the blog of CfC conference. Because this space is just so complex, we basically structured it into 3 areas. Trading, which is big and will be big. Second is financial services. And third is resource monetization or Web3. So please read the article and send me your feedback.
Excellent, thank you. No, it was great content, and I recommend taking a look at it. So, once again, starting at Ken, can you tell us, is venture investing different in crypto from normal investing?
Yes.
And why? Give me more than
I think
others have.
I think one of the things that makes for great investing is the sector you're in, right? So there's a high correlation between being in the right sector at the right time and investing. But unlike traditional investing, some of the parameters of crypto investing, particularly where there's a token or a SAFT agreement, are fundamentally different. So learning how to store tokens, even just accept tokens, whether or not to stake tokens, how you decide to sell because you're liquid, often relatively quickly, are fundamentally different problems than a traditional venture investor is expected to understand and know. And then I think there's this other challenge that happens with super high growth, major tech, almost tectonic inflections in technology, which is there's a lot of crap mixed in with the good stuff. And so the filtering, I think the process of filtering is much tougher. So I would say it's the same, but there are pieces that are very, very different.
And I guess, I mean, there's so much to drill down into there. Actually, we've got a bit of time. Let's drill down a bit into that. It's difficult enough in normal equity investing, right? You've got to make sure the company owns what they own, they've got barriers to entry, they've got the right team, etc. But then if you bring the token aspect in as well, is the expertise available within your investing organizations to analyze the smart contract so that you are actually getting the value that they are offering you as you make the investment? Anyone want to take?
I mean, I don't necessarily think that each fund has to independently audit the smart contracts itself of the protocol. I think that there are like auditing firms that do that. At least from like our perspective, we're a team of two, and like although I'm decently technical, we definitely don't like depend on ourselves for audits.
Third party audit.
I think like what we do have to look really deeply into when investing in tokens is ensuring that incentives like are structured properly and like token networks are like accurately rewarding each stakeholder and like incentivizing each stakeholder to contribute, which is kind of something that a narrative we haven't really seen play out yet. I think token models are still like really in the early stages, and it's going to be interesting over the next 2 years to see like a little bit more complexity as like networks are more nuanced for their specific use cases.
When the altcoin market suffered its disgraceful decline, we wondered, there was many deals done which were, equity and a huge amount of coins where a lot of the upside was going to be in some kind of coin. So I guess the question is, are we still seeing those kind of hybrid models?
Of what? Like equity and tokens?
Yeah, equity plus tokens. You don't see them so much, or you don't look at those, do you?
I mean, like some companies will maybe raise equity at pre-seed just because they haven't structured their token yet, and then swap to a token in later rounds. But by the time mainnet comes around, pretty much no company that I've seen recently is intending to have both equity and tokens, because then like there's an issue in value accrual.
So recently we invested into Agoric, so we have 1% of equity and then 1% of future tokens. And how we look at it is basically, if the network works, token generates the upside, and the equity investment is kind of like a backup plan. In case the network doesn't work, we can still sell the company for example, acqui-hire or intellectual property.
Which company was it again?
Agoric.
Agoric.
I think the problem is an alignment problem more than anything else. And so when we look at it, I think I'm agnostic as to structure between equity and tokens. I think it's something that's important to understand where the value accrues.
Yeah.
But if the management team has equity and they're selling tokens, then we insist on effectively a dividend of the pro rata share of equity before we'll make an investment in a project.
Creating alignment. Yeah.
Because you have to have alignment. Otherwise, you can see down the road, hey, this transaction fee needs to go up. The transaction fee goes into the equity, and all of a sudden the tokens become worth less, or vice versa.
Mabel, you were going to...
Right. I had like two comments. Like first, like to the previous question about token. So I think to add on what Jane was saying, actually, one of the big difference for like investing in token versus like traditional venture investing is that in the past, like you don't really see that much of a investor participating in the design of the incentivization structure at all. Not just like I guess like token economics is a broader thesis, but think about like how much you give to the staff with the company and then advisor and stuff. Like for us, like we are always very keen to kind of be an active part into the design of the token economic models that of the network that we invest, because we do think that's like similar to what Ken was talking about, like deciding whether we are staking. That's like part of the investment kind of decision, of course, like a decision kind of process. Like if the thing was not well designed, we might not decide to do it. And then to the second part, I think it's very, very important to for a company to define, like let's say they at the beginning they decided to do equity and then later on decided to go on a network, then like what, first of all, like how are the staffing gonna dedicate it to each of them? Like, or is it the issuance of the token would actually kind of deprive the value driven by the equity? Because actually I was seeing this kind of thing happen. It was like, unclear structure of, the people who are working for the token and then on the equity side. I'm not gonna mention the name, but that was one of the reasons that I pass on that.
Yeah, we generally don't like companies where it feels like the team is a fallback. So we'd rather them be like very committed to making the token accrue value than have an equity fallback.
You see, that's quite cool because in our hub we see people starting businesses and rewarding and incentivizing amazing talent to join them with the only currency they have, which are tokens as a potential future value, right? So are you saying you're not averse to seeing that, where most of the team is rewarded by the token and then you take tokens because there's an alignment over the value of the token, right? So that's okay. It's where there is other pots of value that you don't have access to. As Ken said, you insist on aligning through structure. Do you know, it's hard enough to invest anyway in companies in regular equity. I think this profession is, as you can see, it's really quite complex and takes quite a lot of specialization. And we start by reading your writing, I think, is one thing.
But I think we as traditional investors completely underestimated this space, and we initially thought we would be able to invest into blockchain with our VC team. We actually had to hire like additional completely dedicated team because even like how you value the token economy using equation of exchange, not a discounted cash flow. So you need a completely different mindset.
Exactly. So the number of companies being invented in this space, it's impossible to do part-time.
Yep.
Because without having a sense of the full market and the relationship between companies, which is more than a full-time job. I'm sure everyone on the stage is reading stuff 7 days a week. You can't do it part-time.
So there's an old saying which applies to investing in many kinds of business. One way to make a small fortune in crypto is start with a big one. What would you advise companies or investors in this room? Would you advise them, if they meet a crypto company, would you advise them to invest, or are they better to invest direct, or are they better to then put their money into a fund where there's some specialization and allow some fees to be taken out for the privilege of having that?
You know, one interesting parallel is if you were an unsophisticated investor in 1998 and you saw what was happening with the internet and you just put $10,000 into every big name company, with the crash that happened later, you would do pretty well if you held it for 10, 15, 20 years. So one strategy is simply buy the big names. If you happen to be one of the investors who was in any of those companies in the seed round or the Series A round, you'd never have to work again for the rest of your life. So you would not just have a great returning portfolio by buying 30 stocks on your own, but you'd actually make, I don't know the count, but there are dozens of companies that went 5,000x in the internet era.
Interesting
globally.
Comparison.
And so the outsized money is being early in the big outcomes, even at the cost of having a lot of failure.
Yeah, I mean, I think that everyone looking to get exposure to crypto should start with Bitcoin, and I consider any other investment to be a venture investment. And so I think like the level of diligence required to invest early stage is a lot more intense.
Yeah.
And so anyone looking to invest in crypto, I tell them to start with Bitcoin and then have a small portfolio that they view as like money that I can afford to lose to do any other coin.
That's good advice. So I want to dive into subsectors.
Can I just make one point on that? I think actually it's not just investing in Bitcoin, because I share Jane's view that it's probably the single best risk-reward investment I've seen in my lifetime.
Yeah.
Everybody should own some Bitcoin, some fraction of their portfolio, 1%, 5% if they're really young. But they should own it directly. And they shouldn't be paying funds 2 and 20 to own Bitcoin for them. And they should not pay attention to the price. They should just buy something every month for the next year or two and allocate their portfolio over time, get exposure, because it's not just a great investment, but it's the gateway to understanding everything else that happens in the space. And if you don't dabble, you will not understand the space. And if you don't understand the space, you may be missing one of the great technology shifts in a generation.
Very good. Let's go then, before we go into subsectors, what is the panel's view on investing in security tokens. Let's start with you, I think.
Me?
Yes.
So we think security tokens are 2 to 3 years out. We are not bullish at all. We try to basically tokenize our fund initially. So basically, securitization of assets has 3 advantages. Number 1 is automation. Create, your asset cheaper, faster. It's not the case. One legal firm quoted us $500,000 to create a tokenized fund. It's $250K to create a standard fund on Cayman Islands. So it's not faster, it's not cheaper. Yeah. Number 1. Number 2, you can potentially get, if you create a tokenized fund or real estate, more investors faster, but the platforms are not allowing you today to kind of, increase that side, so get more money in. And lastly is liquidity. And today you don't really have liquidity. There are no exchanges of security tokens which provide liquidity. So 2 to 3 years out, yes, but not now.
Do you guys want to go first? Because I think probably.
Go for it.
Go for it, Mabel.
All right, yeah, we had some, of course, disagreement on. We didn't really do any of the security token investment at all. But I definitely spent some time thinking about it, especially given, the regulatory change happened in Hong Kong. They started to have the regulatory sandbox for, security tokens. Then, I originally thought, STO is more like an asset-backed security that kind of REITs or those. So I was kind of agreeing with you on your point, but I think I developed a more nuanced thesis about it, is that if we really think about the traditional securities in the market, the traditional finance market, stock is part of it. And then a lot of the great companies, they could have just adopt a model, a work token model, plus some sort of the cash flow, burn back into the token. And that actually should be considered as a type of security tokens. And then that's also not something that's very anywhere available in the past at all, because it's a new business model. And then by work token, maybe it might be a bit unfamiliar for people. So I'll give you an example about McDonald's. In the past, if you eat a McDonald's burger, right, you don't hold the McDonald's stock. So you would not be benefited from it. But now, if, for example, I'm not saying McDonald's should go for it, but if they tokenize themselves and then say a token holder can use that as a discount to access the McDonald's burger. And on the other hand, by providing the cash, let the cash burn back into the token model, at the end it will grow. So it's a kind of a reciprocal model at the end, and kind of aligns the users and investors' interests.
That feels a little bit like an argument that loyalty points are more valuable than cash or stock because they can be used for multiple things. And I think, not to disagree with anyone, because I actually agree with what Mabel and Victor said, but I would say time horizon matters. If your time horizon is long, security tokens are irrelevant to the equation because everything will be tokenized in 10 or 20 years and there'll be liquid markets. But if your time horizon is short, security tokens are a liability. They're a liability because nobody knows how to hold tokens. Nobody knows how to access tokens. You're actually limiting your pool for liquidity because it's a new form of transacting. There's no established marketplaces for buying and selling them. There's no liquidity to the marketplace. There's actually no efficiency and no cost savings. So the arguments for security tokens probably is, I think, more nuanced than simply they're good or bad. It's we will be doing it. They may save costs, they may make efficiencies, but that is not the reason to buy into a project, and probably a liability in the short run.
Jane?
Yeah, and there's actually, I really agree with Mabel, and I think, ironically, the companies that she's describing that use this model, I'm very excited about, but one of the biggest risks to them is that they will be regulated as security tokens.
You also, to just expand on Mabel's model, you have to like a Big Mac for it to be of value, right? So at the end of the day, whether you buy a security token or utility token or a share of stock, the underlying business is the thing that matters, right? Is McDonald's going to be big? And then can the token economy create some kind of acceleration to what's already a good model? So the whole consideration about security tokens is a little bit to me like asking, would you rather invest in a C Corp or a B Corp? Would you rather invest in a note or a Seiff or equity? And I think those are secondary considerations when you're trying to decide, is McDonald's a good company to invest in?
I'm not sure I entirely agree, because I'm thinking about Okay, there's a company in London that has issued £3 million worth of their own stock, their own security, as a security token with the London Stock Exchange, right? Settling on London Stock Exchange's liquidity pool. I think that's an incredibly smart thing to do, right?
But why?
Why?
What advantage is it?
What advantage? Fungibility for them for their token, retaining more ownership of their business, sharing more of their profit, and increasing a wider potential investor base, I guess, is what
But where's the economic...
cost, of course, incredibly low. It's not the cost of an IPO. They did this, by the way, with the FCA regulator.
So I think you touched on a very interesting point, which is I think London Exchange, they have like very good liquidity, but versus like in the United States, like T0 or some of the other like
Fair.
security exchange,
Yeah.
like they, first of all, like I actually tried to, because like one of our portfolio, they said like they could kind of like trade their staff on that. And then like I tried that and I realized that first of all, the onboarding process, it's painful, extremely painful for even a accredited investor.
Yeah.
And then secondly is that like, you know, not many people like have the access being an accredited investor. And also like the infrastructure itself is not where, like the UX again. So I think having London Exchange, of course, that's like absolutely. So I think back to the point about, like, not that I'm saying, like, it's a good time to invest in security tokens, but I think my point is more being, like, we need to be more open-minded about what security or, like, what asset classes we are really thinking about. And the second point is, I think now Asia, they have opened up the kind of door for a lot of the good regulatory environment, like Hong Kong, like Singapore, and maybe with, you know, more like a top-down kind of structure from the government, like, they could have better progress, maybe.
It's interesting because I'm not even sure that I mean, it's good. I mean, we're open in saying we're watching and we're learning, right? Which is the truth. But I'm not sure I entirely agree because I'm thinking about air miles, right? What you said about McDonald's can mostly be achieved with a loyalty and a voucher scheme, mostly, pretty much. Maybe an enhanced
You can't burn
one.
the cash back.
Probably can't burn the cash back.
That's the important part of being a
course.
security stuff.
And if I thought about my air miles, which I barely use, but there's no incentive for the airlines to do that. I think if we all used our air miles, the airlines would be bust. But if there was an underlying ownership aspect as well within those air miles, I think it would definitely create loyalty. So as a mechanism for loyalty, for me to own a piece of my favorite brands and enjoy the benefit of their collective profit, is there a market for an opportunity for security tokens there? What do you think?
So no, I would just have to repeat what I said. I think later, but not today, because it's not really helping automation. Lacks liquidity on the exit side. It doesn't really help you to widen your customer or investor base.
This reminds me a lot of 1995, 1998, and sorry to go back there again. But when you were talking about the internet and investing in the internet then, people were talking about email, they were talking about content, they were talking about retail, and a little bit about entertainment. And when you look at the great outcomes of the internet, it was not the existing industries that went online. It was not the operating efficiencies of transmitting data in the back office that made the big outcomes. And for a venture panel, we're looking for big outcomes. It was the creation of entirely new forms of business and categories of business that couldn't have existed without the internet. And so security tokens are just a thing. They don't make it a great company or a bad company. We take into consideration the structure, but it's not by any stretch one of the 3 or 4 or 5 most important considerations.
Fair enough. I think we've dived into that long enough. I tried security token fans. We'll try this panel again and see if we can
understand you
get them round to the next time. Does it show? I like an underlying asset, just old-fashioned. Except I will say, though, I want to ask what subsectors you're interested in. And Jane, I have to say I was quite excited because a lot of people here know the story that I took payment for desks in 2013 in my hub in Bitcoin. Of course, I had no idea what I was doing, but I also started trading in them. And eventually, my daughters got married, I sold them, and I used the profit to pay for the weddings of my 3 daughters. They had great weddings because the market was up. But it also made me one of the first people in the UK to pay tax on my crypto gains, which was incredibly hard to do. And then I saw you guys have invested in a tax company. Can you say anything about this?
Yeah, thanks for setting me up. So I can't say much about it because they haven't released their full product scope publicly yet, but we invested in a company called TaxBit. The founder was early at Qualtrics and is an incredible entrepreneur, so we're really excited about him. We invested at Seed, and they essentially provide a retail solution for cryptocurrency tax automation.
So roughly when can their products come to market, do you think?
A couple of weeks, they'll be ready for
Oh, right.
season this
That's
year.
soon.
Yeah.
Oh, sign me up. It really is. It was so hard to do. Those of you that have done this, it's just incredibly hard to do, especially if you were in and out trading way back then. So it's a terrific idea. That's a great example. Other ideas?
It's also a great example of an advantage that a fund has. My personal tax return was over 1,000 pages last year. A trade is not a trade. A trade is pages of trades, of micro trades. Yeah. And the complexity around it and the first in, first out, or last in, first out, or assigning cryptocurrencies to a transaction requires a massive amount of work just to optimize for taxes. So this is one of those things that is going to be solved by companies like TaxBit, but it has not been solved well yet.
It's also a good example of, in a gold rush, sell them picks and shovels. So well done, it's a good one. Some more examples. What are you folks looking at? What's hot for you? Who wants to say that?
So just from like a traditional investor perspective, yeah, how to generate yield, that's how we look at it. And basically, crypto allows us to have like asymmetric returns. So our bank is Julius Baer, fantastic bank, yeah. We pay, I think, minus 0.75% on positive balances. On the other hand, if I take that US dollar, convert it into DAI, which is a stable coin, 1 DAI equals 1 US dollar, and just hold it, it generates 5 to 6% yield per annum. Of course, there are risks, blockchain hackers risk, but you get 5% risk like that, 5% yield, sorry. Secondly, are lending borrowing platforms. So if you go on a website called loanscan.io, you can actually generate yield, 10, 12%, if you lend your fiat money on Compound or Dharma or Kyber or other platforms. Thirdly is staking. If you go on a website called stakingrewards.com, you can see, there are yields, tens of percentages. So this is a segment we are excited about.
Cool.
Right.
Mabel?
Open finance for sure, but I feel like you might touch upon it later on, so I'll expand then. But another very interesting, I would say, unique company that we invested was that, they were seeded by Google Venture at the beginning, so they're an IoT company. Originally, what they were trying to do is that, obviously, in the past, people have tried to solve the problem of how you really kind of identify, find where your dog is, or find where your bike is, by adding some sort of sensor, right? But then, in the past, the solution has always been Bluetooth or some sort of other very power-intensive kind of solution. So this company, the unique part about it is they're using LongFi, which has coverage more than 10 miles. And then basically, the idea was that by having a sensor on your dog's neck, and then you can identify wherever, as far as there's hotspot coverage, you will be able to identify where it is. And then, so why do they need a cryptocurrency? That's the interesting part. When they try to raise their Series C, they realized that it's really hard for someone, let's say they're using the network, try to identify where the dog is, and then to pay someone permissionlessly on the street to people who are providing the hotspot coverage. So then, they came to us, and we kind of designed the whole token economic model for them, and also how the whole thing's built out. Of course, the tech part they figured out already. Now, they're already shipping tons of. I wouldn't say tons, but I forgot the number, so I say tons.
Couple hundred. They just sold out, right?
More than that. Yeah. More than that. In the United States, a couple they have hotspots to people. So buying in house, and people just by running those hotspots, launching the LongFi, they can earn cryptocurrency. And then people who use that, they would pay permissionlessly.
And just as an investor, you help them design that model, right?
The token economic, not the hardware.
Yeah, but
so that's the right kind of logic that you go
cool.
from hardware to cryptocurrency.
I really like that as an example. I thought in a minute you were going to say the dogs were mining by running, but no, maybe not.
No, it's called Helium. People should check it out.
Okay, that's awesome. Ken?
We sort of look at it and say it's very early. I liked what Avichal said before about his vertical framework, but we think about it in terms of where we invest into really two categories. The first one is the base layer protocols. If somebody could have found a way to monetize HTTP or SMTP, they'd be very rich today if they had attached a toll to using those protocols. The blockchain, we have found a way to own parts of the protocols in this token model. So owning those base layer protocols is something that's very important to us. We think there will be multiple trillion-dollar outcomes from the base layer protocols. Our view is it's better to be in more rather than less because the winners are not clear yet. There's likely to be regional winners in that space, and China and India may have their own, and US and Europe may share one. There's the connectivity between those protocols, like interoperability protocols, that allow one network and one protocol to talk to another. So we like that space a lot. And the other space we like is what we call the holy shit sector, which is these are the categories of business that don't exist today. And when someone shares the idea with you, you say, holy shit, I never thought about that. It's Airbnb, it's Uber, it's Google, it's Facebook. Now, there are plenty of losers in those spaces too, and the first mover doesn't always win. We saw 6 Degrees in Friendster and MySpace before we saw Facebook and LinkedIn. So we might make multiple investments in actually the same defining category, but we also prefer sectors that are not obvious. So when there's a trend on a sector, we tend to avoid it because customer acquisition costs go way up, a lot of money gets lost, and it's not so unobvious.
I want to make sure I leave time for questions. Sorry, yes, Jane, did you?
No, I just wanted him to mention Figure.
Yeah, you should mention Figure.
Figure's an investment we've made. We're actually late to the game there. We were a Series B investor in Figure. And again, that goes to the thesis that once you find a great company, the really great ones are great for a very long time. And we saw in Figure a lot of the same things that made Amazon great. So one of the reasons that Amazon distinguished itself was by their one-click shopping and their Amazon Prime. Figure is a HELOC lender and more broadly a lender. And they're using the blockchain to create real transparency around the lending process. But they've done 2 things that are equivalent to one-click shopping and Amazon Prime in our view. One is they approve the loan within 5 minutes. And the second is that they deliver the funding within 5 days. And that is a material competitive advantage, which we think will create a moat around their business as they get better and better at the data mining. It's a world-class team. They started with HELOCs in March. They've done well over $1 billion of origination in their first year of doing this. They've raised $1 billion of capital already from Jefferies and Providence.
There you go.
And we think there's a lot left in the trajectory of that company. So that's been one of them.
Awesome. Quickly on Vega.
Yeah, so it's a decentralized exchange for derivatives. Derivatives currently is not an efficient market. It costs $2 million to create a derivative of like a forex exposure. If you are, for example, selling something to Myanmar, local currency. In the future, we'll be all like creating and settling derivatives on Vega protocols.
Some good examples there. Quick word on DeFi or open investing. Go, Mabel.
Yeah, I was going to say, like, if we have time. Yeah. I really enjoyed the previous panel, and I think I have some like unique view on DeFi and I would say open finance, because I think that's what it really means. Because I think right now, one of the key problem with all these open finance solutions is the product market fit. So people if you analyze the addresses, and you can kind of figure out like people who actually use Compound, or a lot of them are like a big OTC desk or traders who are like trying to get the arbitrage. But that's not what we were supposed to, or like we intend the open finance solutions for, right? So the actual market fit, I think, should actually happen in China and Southeast Asia and some of the other like One Belt, One Road countries or like developing countries. I would use like data to like support this. Basically, if you go back and see like the China P2P and also like some of the lending P2P platform in Vietnam and some of the other Southeast Asia countries, you'll be amazed at how many of them are actually needing it, because a lot of the loans cannot really be approved from the traditional banks, and people in China, they're at the school, like college students, they actually need to apply for loan on a P2P market for iPhone, and then try to pay it back gradually. So I think that's like a big thing, and I'm not seeing. Well, we are actually seeing one of the deal. I can't really say it for now, but it will be very interesting. It's like a Chinese version of Compound, and then and then they're doing some other stuff similar to Uniswap, and then they're trying to become like a rocket internet kind of company that aggregates everything and then try to satisfy the need of people on the ground. And I think another even larger demand from China would be international cross-border remittance. Because one of the things that I realized by talking to one of the Chicago OTC desks was that every day, a lot of the Bitcoin settlement they had, that's from China, and then they were like curious like what they were actually doing, and they found out was because of the cross-border e-commerce people they were trying to settle from RMB to USD, and that could be a very compliant case because like most of these merchants that use like cross-border e-commerce, like they already have compliant USD account and RMB account, so that makes a very compelling case for people to want to settle as fast as possible.
Not using their capacity and switching it some to those regulated accounts to allow...
Well, you need off and on-ramp solution for sure, but you need both sides. That's kind of my comment on it. So I think the combination of CeFi, which has the ability to provide compliant on and off-ramp solution with some sort of DeFi already existing platform will be very, very compelling.
Any other DeFi comments?
It's actually going to be a really interesting point of leverage is in the P2P marketplace, where the individual has very little negotiating power against the centralized entities that exist today. So the fee structures are enormous. And so one of the first places we're going to see massive disruption in DeFi or just in blockchain in general is in the person-to-person marketplaces. I think we'll also see things like, because of the smart contract nature, we're going to see a new sector emerge, which there's no name for yet, but we're calling device-to-device, D2D. Think about autonomous vehicles are happening. They're gonna be owned by DAOs at some point. So multiple people will own groups of cars. Those cars will be picking up passengers and dropping them off. They're going to be electric because that's where we're headed as a world. How do those cars recharge? Those cars are going to have to go to a local house to recharge. When they go to that local house, that car is going to have to pay that house for the electricity. And so these marketplaces that exist today are a part of it. There's going to be incredible efficiency and disruption in P2P marketplaces, but there's also going to be, because of the smart contract nature, the efficiency of it, the tokenization and the economic impact and the game theory behind that, there's going to be an entirely new sector of disruption and creation in the device-to-device world.
I love the idea of waking up in the morning and there's a car outside the front that my personal AI-powered robot has negotiated with all my neighbors to pick me up.
You're going to wake up and you're going to have a wallet full of tokens.
On that bombshell, we're going to have to end it there. Please put your hands together and thank my wonderful panel.